All right, well, greeting everyone, and welcome to our day after Memorial Day, start of summer edition of the Roundtable. Officially, it's the May 2020 Roundtable, entitled "It's a Beautiful Thing." And the beautiful thing on the slide there is basically Norway. It's quite. I'm told that's an unfiltered shot, which I swear should be a portrait, but it's actually a photograph with no special filters. I think that qualifies as pretty beautiful. And speaking of beautiful, we're joined here by four beautiful people tonight. Kim Butcher from Florida by way of Evansville, Indiana. Ken Kavula from mid-Michigan. Cy Lynch from Atlanta. Hugh McManus from Pasadena. And what those people all have in common is they have a beautiful track record as investors, long-term investors, and we're just proud to call each other friends. Good evening, everybody.
Good evening. Mark, I just wanted to take just 10 seconds to thank everybody for all the wonderful notes about the flooding here in mid-Michigan. They hear mid-Michigan and they assume that that's where I live. I actually live about 65, 70 miles away from where the major flooding occurred. But thank you so much for all the emails and all the concern. Everybody in our chapter appears to be okay. We did have a couple of our directors in the middle of some of the flooding, and it's a terrible, terrible thing even today with those broken dams. But it's much better than it was a week ago, and thankfully nobody got hurt in any major way of any kind.
Yeah, in fact, we heard from Paul Witt today, Ken, that he said everything is fine. His house and family are fine.
Yeah.
So good stuff. That is not a picture of Midland, Michigan on the cover slide. All right. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, one of the sponsors of the event, and let's go ahead and get underway. Here's the legal paperwork. No investment recommendation whatsoever is intended. This is about education. Everything we do is for a very powerful continuing theme in all that we do, demonstration. We are illustrating and demonstrating. Please do your own homework, make your own decisions. If you'd like an event email reminder, please email Natalie Kavula. That's nkavula1@comcast.net. And if you'd like a copy of slides or if you have follow-up questions, my email address is markr@manifestinvesting.com. And I'll also thank the hundreds of people who sent me requests for copies of slides from our recent COVID cancellation conference. And I think I've caught up to everybody, but if you haven't seen them yet and you want them, let me know. All right, we have a really busy agenda tonight, so we're not going to waste any time. Again, welcome, especially if you're a newcomer. We keep this fairly casual. We do kind of whip along. Ken and others will be watching for hands in the air, that sort of thing, but we do have to kind of protect the schedule a little bit. We'll talk a little bit about the recession watch that we've looked at for the last several months. And then our main theme for tonight is basically going to be listening to Cy. And not just Cy tonight, but listening to the stuff that Cy Lynch has had to say about portfolio-centered decision-making over the last, I want to say a couple of months, but he's probably going to say it's been more like a few years. We want to keep
probably right. Real loud a couple of months.
Yeah, well, we want to keep that portfolio return forecast up, and we're going to take some steps in that direction. We'll take a look at the performance results, challenge a few stocks. We actually have a selling list, and then you see the 5 company selections on there. Audience poll before we're done, and then we do, time permitting, leave things open for questions and answers. Just as a reminder, we're here just trying to bring an idea for further study, a single opportunity to take a look at. We do keep track with a tracking portfolio. We would like to beat the Wilshire 5000 market benchmark by at least 5 percentage points over the long term. We'll talk about how well we've been doing, and we do like to actually have our selections beat the market more than half the time. Just as a quick reminder where we've been here recently, the graph that you see on your screen depicts the Wilshire 5000. That's the green shaded area behind the graph, and it's been quite turbulent over the last year and a half, going back to Christmas 2018, and then what we've gone through here with the COVID virus here in the last few months. The blue bars are the median, you could call it average, but it's a median projected annual return for all the stocks in our database, about 2,400 stocks. And you can see that we recently reached a peak in return expectations that rivaled what we saw 10 years ago. And this is what we've been kicking around and what Sai's been nudging us about. A couple months ago, our portfolio return forecast, PAR, was at 14 when the median market forecast was at 14.7. So we'd actually, we didn't allow it to drop down below the market average. It went there because our stocks have actually performed very well. And we'll talk more about that as we go. But we are back at 10% for the median return forecast for the average stock out there. Any question or comment on that, Ken or Sai or Hugh or Kim?
No, we're staying up to date on our questions here, Mark, so that's good.
Okay, so let's go ahead and press on. I did just wanted to take one quick moment because we have been watching this as a community. What you're looking at is the value line arithmetic average, leaving out the financials, leaving out the banks and insurance companies and looking just at the industrial companies. And the top graph is from back in September 2019, and that's what we were looking back at that point in time. And what we want to focus in on is how much that has changed since the first part of this year. You can see that towards the end of last year, we were looking for a 9% net margin, average net margin for all the industrial companies. And you can see that just recently dropped below 6, the expectations for this year. So we actually are in a situation that rivals the severity, at least on a profitability basis, of what we saw 10 years ago. So we're on the verge of triggering a nasty recession. Hopefully the stuff that's going on right now will curtail that a little bit. But you can see that the drops down for 2020 and 2021 over just a period of literally a few weeks have been quite staggering. And it's been enough to drop the long-term return forecast from 9% to 8% for the average stock. So it is, the way we think of recessions within our community is they really do damage, sometimes very painful damage, to our stock selection guides and our stock studies. All right, so how are we doing? Here's a look at the long-term performance of the roundtable, the tracking portfolio. Every time we pick a stock, we put $1,000 into it and track the performance of that $1,000. Our rate of return since inception is now standing at 16.7%. We've had a spectacular 4 or 6 week run with the holdings in the portfolio. The Wilshire 5000 with mirroring investments checks in at 9.4%. You take 16.7 minus 9.4 to get the relative return of 7.3%. That's what's graphed on this page. Anything above the red line is beating the market by 5 percentage points. That's our goal. We want to beat it by at least 5 over the long term, and you can see that we've been chunking along pretty well over the last few years doing precisely that. And we're pretty much near an all-time high at 7.3, and we hope to stay there and perhaps improve on it. Any questions or comments, Ken?
No, we're still keeping good, Mark.
I'm not,
Roxy was barking at you, but other than that.
I'll make just one observation because that is a remarkable performance. But I look at the last line on the results, outperformance accuracy 50.4%.
Mm-hmm.
That basically means we're 50% of our stocks outperform the market picks, 50% of the picks underperform the market. Yet look at the outstanding results. The lesson being you don't have to be right all the time. Just be right big on some and then do your best not to make huge mistakes when you're a little under.
Exactly. All right, so let's talk a little bit. Again, one more reinforcement slide. if you actually take a look at the performance of the roundtable tracking portfolio and stack it up against some of the best performing funds since July 2010, that's our 10-year birthday's coming up in 2 months from now, we actually are in third place behind two T. Rowe Price funds, and those are two very formidable funds in terms of long-term performance. And so we're checking in just behind the two of them, and there's a number of very good, well-managed funds. Some of those are excellent sources of ideas for further study if you track the internal portfolios. All right, so let's talk a little bit about the actual portfolio itself. Again, we invest $1,000 into any idea. The legend up at the top tells you how many times. So for example, the number one holding, Microsoft, by percent of total assets, it's up to 9.7% of total assets. It's been selected 5 times. $5,000 invested into Microsoft is now worth $40,000. So that's how you read the legend and read down the page. You see companies like Amazon is just a 2-time selection. 2 times has become 16,000. And again, it's a portfolio that's been quite rewarding to us, and it's been a lot of fun to demonstrate. Anything jump off the page? Anybody?
Yeah, what jumps off the page to me, Mark, is $38,000 in Apple performing at only 4.5%.
Yeah. I mean, it's gone from $40 to $320 in the time that we owned it, the first position, I believe selected by Ann Manning many years ago. Good stuff. The one thing that you will notice, the average, we'll cover this in a second, but the average stock right now is at 10%. This particular portfolio has an 11% projected annual return. That's an average return forecast. So that's a little bit low. That's what we want to attack here and assertively repair. And then the growth rate's just a little bit low at 10.5%. We'd like to see that at least 11, somewhere between 11 and 12, preferably.
I have 3 or 4 of you asking if this is the entire portfolio. No, it's not. That link at the very top of the page, maybe Mark, you could underline it or something. There we go. That link right there will take you to the entire portfolio. This is only the top 20 or 25 holdings. The averages, however, do represent the entire portfolio. So this column that you see will not add to that 421,000. But if you want to see all the holdings, you can take that link. It's a public link, and it will take you to the roundtable dashboard.
Yeah, that's the top 20 out of what I think is now 57 positions. Okay, let's keep trucking on. During that conference we had last week, we talked about some selling disciplines and strategies, and I'll boil it down into a quick nutshell discussion. We asked a very simple question. What if we took the round table and didn't do any of the selling type stuff? We'll sell on a breakdown in quality. We'll sell on a disappointing performance after selection, our rule of 5 type consideration. And we also will sell an individual holding when its projected return dips too low all by itself. It can be a standalone decision. If the projected return on your stock drops down to minus 5%, we would sell it and move on to something else. And so we asked the question, well, what if we had just not done any of that selling? What happens to our 16% return? And what actually happens if we didn't do all of that that's selling, the type of selling that Cy's been encouraging us to do even more assertively? Buy and forget would have delivered 11.8%. And we think that's a pretty compelling note there. And, you know, make that comparison with the Wilshire 5000. And although it beats it, giving away 4 or 5 percentage points of performance would be pretty gruesome. So we think that the selling disciplines that we talked about during those sessions and continue to try to implement really do have a lot of merit. And keep in mind we are talking about now basically 1,000 transactions on this portfolio, going back almost 10 years. All of them done in broad daylight. So now what I will do tonight is basically bring a proposal, much like you might do at an investment club meeting. What I would like to do is take the 10 lowest return forecast companies in the portfolio and sell them. You can see we've got Skyworks, IPG, Apple, Gilead, which we'll see in a second is the only one that's a little bit tentative, but some real community favorites on there, and then a couple of us that have just not done very well. But we're talking about $89,000 in value. And again, a way to think about this, in the typical investment club portfolio of 12, 16, or 20 stocks, this would be the equivalent of talking about selling 2 companies, approximately 2 companies. Here's what it looks like. With the portfolio par at 11% and the median market return at 10, we really want to try to get that back to 15. And again, we preach about not trying to do it all at once. We've actually been doing this over the last few months. Our stocks have been not making it any easier because they've been doing so well. When our stocks do extremely well with respect to stock price, that keeps driving our return forecasts down. So what you're looking at here is the close of business tonight, the projected return for the 10 stocks that are on that preceding page. These are the 10 lowest return forecast as measured by the projected annual return in the portfolio. Okay, so those are the ones that are on the chopping block. Only one of them is there because of fundamental weakness. That happens to be Lemaitre Vascular. The other 9 are there because they've been successful. And as you look across the page, I'll draw your attention to just take a look at these numbers in the value line low total return forecast. That's a 3 to 5 year forecast. And notice the general tendency. They're basically low single digits with a couple of exceptions. I don't think anybody would disagree with that. Take a look at the Morningstar perspective. Anything over 100 is a company that is fully valued. And some of these are quite fully valued in the opinion of Morningstar. So again, these all pretty much align. And it's pretty much true with the analyst consensus also. Notice that the 1 year return forecast for many of these are fairly weak. So we're probably high-fiving at the water cooler and setting these free, saying thank you at a good time for most of them. Some of these will continue on with plenty of momentum and we'll regret selling them. But again, we want to think about this in terms of impact on the overall portfolio. That's what you see with the before and after slide there.
Mark, we're having some of our own words thrown back at us about core and non-core stocks. People quoting the rule about selling core stocks when their return reaches money market and selling non-core when they move below MIPAR. That's true, folks, but those guidelines are for when par in your portfolio is satisfactory. So when par is satisfactory in the sweet spot, then those rules take over. But the par for this portfolio is not in the sweet spot. So we're going further now, and we're making an attempt to move into the sweet spot. And Mark's right, we're not going to try to do it all at once, but we are going to be moving, if we make these sales, from 11% portfolio par to 12.5%, and that's a pretty decent move in one night. Mark, Orlando wants to know, what do you do with dividends in this portfolio?
The dividends are reinvested. It basically is reflected in the share totals for the companies. All the prices are dividend and split adjusted.
Okay, Cynthia wants to know, are you carrying any cash in the portfolio?
No cash.
Okay, and Dennis wants to know, are you selling all of the position when you make the sale?
Press any key or hold the line to listen.
We're holding the line. No, we're selling entire positions.
Okay, and Eugene wants to know, are we treating the tracking portfolio a little bit different than an actual club portfolio? I think the answer is yes, starting with the number of stocks that it contains. What else would you say to Gene, Mark?
Yeah, it's going to emulate it. What it is you basically, instead of having 16 positions, you have 60. So, you know, it's
Well, there's
obviously a little bit
another
different.
huge
Go
there's
ahead.
another huge difference between the roundtable portfolio and any other actual portfolio, and that is that the 89,000 or whatever that we are quote selling tonight is not reinvested.
Right.
If you were in a club or your own personal, you would either hold that as cash, spend it, or reinvest it. And we do none of the above. Well, I guess you could say we spend it. We, like you said, we high five and
Yeah,
rejoice.
we basically pretend to distribute it, and that is a little bit different. It's probably closer to an individual's brokerage account being connected to a checking account. But really,
Yeah,
what we're doing with the tracking portfolio is tracking, the rate of return, reflecting that cash flow. So,
right.
and that leads us to, well, let's finish up with the portfolio. Yeah, we will get an extra 1.5%, and that's before actually adding our stocks here tonight. We actually do get almost a percentage point improvement in the growth, which is something Ken wants to also address. And it's happening naturally tonight, but we want to be very vigilant about that, keeping this number between 11 and 12. So it kind of works out tonight without actually aiming at it, Ken, and the quality stays pretty much the same.
Yeah, you sold me on that second line, Mark. The first line I thought, the second line sold it. Okay.
Okay, we're done. All right, so we're going to go ahead and do that. One thing that I do find fairly interesting, because we were getting fairly close to this, and because of the unique nature that Cy just mentioned, we've actually made 555 purchase decisions since July 2010. That means we've invested $555,000. Well, we've sold off a number of positions over the last couple of years, so we have now distributed more than we've invested. So we've basically distributed $45,000 more than we've invested. Could say we're playing with the house's money, because even after all of that distribution, the portfolio will stand at nearly $350,000 when all is said and done. I think that's kind of cool. That's what a rate of return of 16 or 17% can look like after 10 years. And I think it's kind of cool. All right, so we'll go ahead and do that.
Well, it's interesting. I just see that Bill Thompson makes a comment / question about you don't pay taxes on this portfolio. Again, back to what you were just saying about distribution. In one sense, now this isn't exactly right, but in one sense, we pay 100% tax on the sale.
I'm not
Because
sure if
again,
I'll.
it is not reinvested. In other words, this is not as some model portfolios or some mock portfolios where you make a sale and then you reinvest the proceeds of the sale without taking into account taxes or brokerage commissions. You could say that you are artificially inflating the portfolio return because you're compounding money that if it were a real money portfolio, you might not have. This portfolio does not do that. It is in the sense of compounding, it's the same as if we paid 100% of all proceeds, not even just gain, in taxes, because as you said, it's distributed. So to say that this portfolio doesn't take taxes into account, which is an accurate statement that we don't account for them, it also is true this portfolio does not benefit by ignoring taxes.
Yeah, and you also don't get any benefit of tax loss considerations either.
That is correct. Those that we sell. So again, this is a tracking portfolio, and not to belabor it too much because we certainly don't want to go way over tonight, but again, raising the question that people were asking about the core, non-core, one of the reasons that you've not heard a lot of selling discussion outside of selling for quality purposes or selling because of significant disappointing relative return, which is a relatively new phenomenon that Ken and Mark and us in the portfolio have been playing with. And then the core non-core valuations, we've not managed this portfolio as a managed portfolio. We've simply given our best ideas at the time and then pretty much let it run. If this were actually managed like a club or an individual portfolio, we would probably not be talking about selling C.H. Robinson at 7.1%. That's a relative core holding. We could debate it a little bit if it's somewhat cyclical, but it's a high quality, pretty steady company, relative core, certainly not a non-core speculative holding. Same thing with TJX as well at 6.5. On pure isolated valuation, we would not be having this discussion. The reason we're having this discussion is that portfolio par is at 11, which is between 4 and 5 points below the sweet spot. And so when your portfolio gets in that shape, if you are managing it as a managed portfolio, you have to sell something, regardless of what that valuation is. And the way you normally do it is exactly the way Mark is proposing tonight. You peel off the bottom.
Another way to think about that same thing is TJX would not be a sell in other portfolios.
Exactly, which is one reason, and I'm glad you mentioned that. That's one reason why I cringe when people talk about, is the stock in the sell zone or even the buy zone? Because the answer is it depends.
Exactly.
And what it depends on is the rest of your portfolio.
I'm going to nudge us forward, Mark, because it is 9 o'clock already.
Okay.
We do have a number of people in the audience that are wondering whether any of this is real money. None of this is real money, folks. This is all imaginary. We're showing you what a group of very interested amateur investors can do over time. We're demonstrating, but we're not putting real money into this portfolio at all. With that, let's move on, okay?
Feels like real money, Ken. I mean, that Apple. I'm in physical pain over here, and you're saying it's not real. So, all right, moving along. All right, Cy, go ahead and take us away with EPAM Systems.
All right, and I'll try to say that since you're spending much of the night listening to Cy, you have already listened to him, and I'll seek to be relatively brief going forward, particularly since this isn't a new pick. EPAM Systems, it's a, we'll look at it. Most people have at least some familiarity. It is a software consulting and development firm, IT type of firm along the lines of a Cognizant Technologies, and Infosys are two other holdings in the portfolio that are somewhat competitors. And you can see from this history, very strong and consistent sales growth and pretty solid earnings and pre-tax profit growth. Next slide. I looked at the portfolio, ranked it by par, and you see that EPAM is the highest potential return according to the manifest projected annual return that has a excellent quality rating. Xerox there has a good quality rating of 77 with a little bit higher potential return. So that kind of brought me toward looking at EPAM. Next slide. Then I did, as I usually do, a quick industry study simply by clicking on the industry that EPAM is in, which you see is info and technology services companies. In this case, I ranked by par. I frequently rank by quality. If you rank by quality, EPAM is the top, as you can kind of see here just looking at the quality column. But I ranked by par. And again, you see that the highest is EPAM. Next slide. That has a good quality. All right, here is a little bit more detail on the company. It's 27 plus years old of the company. They've got 33,000 people serving customers in 30 countries. Most of the business is in North America, and then about another third, that's about 60%, about another third, about 30% is in Europe, with a little smattering in Asia and Australia. They service essentially 5 industries, and then kind of a collection of industries that we'll see graphically in some other slides in a moment. And notice that it's been recognized as high growth, both as public tech companies as well as IT services. Next slide. Here's just some graphical representation of some of what I referred to there. You see in the upper right-hand corner, the geographic breakdown of revenues in the second quarter of 2019. Granted, that's about a year old, but it hasn't changed drastically. This is just the most recent slide of this nature that the company has on its website. That's why I'm using it. And then you see the industries, the 5 basic industries that they serve. Again, no industry being a whole lot of the business. It's spread pretty evenly. And then that last circle that they call emerging, that's just kind of a collection of some new clients in new areas that they're looking at. It's their emerging companies. It's not really a separate industry. Next slide, which is kind of my favorite about why I like EPAM as a company. They focus their clientele. They have good stickiness with their clients, and they like to serve leaders in their industries. So you're buying, as Diane Gracie used to like to say, and I thought really helps hold things together. We're selling, or this is a company that sells picks and axes, picks and shovels to the miners. You're not trying to pick what company or even what industry may succeed. You are picking a supplier to a bunch of companies and a bunch of industries, providing essential tools. And you see just across the board, they serve the top companies in these various industries. Next slide. Here's my bottom line, the judgments. Growth rate of 22%. That's, I believe, in line with the manifest consensus. It's well below the historical for the last 5 years. Net margin, a little bit, well, is roughly the same as it is now as my projection. I think most analysts project the margin to go up a little bit. PE, interestingly enough, I'm projecting PE, you talk about PE expansion, I'm projecting PE contraction, relatively significant. You might call that alarming, but the reality is the growth is high enough that you still get a good return, even letting the PE ratio return to earth a little bit. And then you get a projected annual return right at the median, roughly, for stocks, a little above. But notice there's plenty of room for pleasant surprise. My high PE return is about 17, and the manifest consensus is also right at 17. So I'm adding another $1,000 of EPAM. And Ken will like it because of that nice 22% growth rate.
Right on, Si.
No campaigning. All right, let's go ahead and turn to Kim Butcher and her offering of Wyndham.
Si did it in 7 minutes, Kim.
I'll beat it. I'm always the least talkative of all of you guys. I'm going to talk about Wyndham. When I was thinking about what was happening to the coronavirus and how it was affecting the market, I thought of when I presented Chubb, the insurance company, and I thought about how the hotels.
Yeah.
When you mute.
Yeah. There is a thunder hailstorm
I know, I
coming.
already saw it.
Okay, just wanted you to
I
know.
already got it.
Well, I'm a cruise, so everything's shut down.
Okay, Wyndham Hotels, when you look at the manifest dashboard, it has a very low quality because it is a recent spin-off. It's only 2 years old from Wyndham Destinations, and that split off into Wyndham Hotels and Resorts and Wyndham, I don't know, it's the timeshare division. Next slide. This is a worldwide company. They've got hotels everywhere, so it is got growth everywhere. But the biggest thing I liked is right now when people are talking about airline stocks, how they'll do, people have to fly somewhere to get there. Well, nearly 70% of their hotels are all people driving somewhere, so they have a minimal exposure to business class. And those hotels would be easy for you if you're in a foreign country or if you were here in the States driving somewhere to spend it at a hotel. Next slide. There, since it's not relied on air travel or international travel, you can see that it's in the small metro and interstate area. And most people, they feel, will be taking more vacations, just drive vacations, driving somewhere. So 96% of those hotels are domestic. So next slide. The number of hotels worldwide, this is from their last quarterly report. I got all these slides. Believe it or not, it's not Marriott, it's not Hilton, but Wyndham has the most number of hotel rooms worldwide at 9,200. It is a franchisee, so when you're getting Wyndham Hotels, they only own, I believe, one hotel. They're all the reservation system and the security systems and the cleaning staff. They manage all the parts of the hotel. So franchisees, people buy the hotel and they want to be underneath the Wyndham brand because they get the highest return on invested capital out of all the hotels that are out there. So it's a very asset-light business, Wyndham Hotels, because they don't own the hotels. So there you go, minimal exposure to incentive fees, and their capital requirements are very little. Next one. This is the thing, the hotel industry is judged by revenue PAR, revenue per available room. When we had COVID, you can see on March 21st, they had 50% of revenue per available room, how much they had lost. But in April, it was down 71%. You can see on how it's now, as of May 2nd, it's gone back to, they've lost 59%. So those numbers are improving. People are getting out and traveling more. I have a family member who's going out on a motorcycle ride. So occupancy levels are picking up. And you can see by the graph that they've got here, that was as of May 4th, what's doing the best is the economy or mid-scale segments of hotel rooms. And Wyndham has the highest number of hotels and hotel rooms in that economy mid-scale segment. Next slide. Now, they've got the flexible business model to save cash. One of the things that they've done is they cut their dividend 75%. They're paying 8 cents a share in dividends. It had been 32. But you know what? I'd rather have them save the money so they have less expenditures so that they can keep on doing well. Overall, they've identified that they can have $255 million worth of savings by reducing their advertising, reducing transaction costs, reducing their discretionary spend, as you can see, and how much they can save. Next slide. They reduce the dividend, like I said, and you can see where they're spending their free cash flow and their money, but they want to be great capital allocators. And so they want to give you great returns. And in keeping that strong liquidity, they've taken out their credit area that they can. Now, in reducing the dividend, if you look at the quarterly report, when they gave their earnings release, they said that once COVID gets done, they will accelerate the dividend. So I fully expect it to get back to where it was. But we as investors are thinking 3 to 5 years from now. As I do this presentation, remember it's 3 to 5 years. How long do you think it's going to take the market and this stock to come back to where it was? Next slide. Here it is on how much they've burnt in the cash flow. So they're negative $16 million this last month, but they do have 47 months of liquidity to keep everything going. Now, 47 months is 2.5 years. I really don't think, or no, three and a half years. So I really don't think, because of what's going on with COVID, it's going to take that long for things to bounce back, in my personal opinion. Because you're already seeing where the revenue per available room from that slide we showed you earlier is bouncing back. Next slide. This is the most recent value line from May 1st. Mark, I'm going to have you circle a few things for me, okay?
You bet.
The stock closed today at $47.48. Notice what the price was May 1st, $32, and it's already jumped to $47. In the projections box, look at where Value Line thinks that the lowest price it could go to would be 60 for 3 to 5 years from now, then a return of 19%. Well, we've already got that. We probably lost half of that already, but 60, remember that number 60. But look at where revenues are going out and how much they're going forward, and look at what the cash flow is. Even though the cash flow per share is reduced down because of the COVID, now if we get back to occupancy, I'm going to see where this is going to go shooting straight up, because this is a cash flow generator. You can see where in 5 years out, the capital spending is going to be $1.30 compared to $1.45 for this year. That's less. Look at how the book value is going up from currently in 2020 of $14.40 to $25.65. That's great capital management. Our outstanding shares are going to stay the same. Our PE, when the stock was at 32, it was going to expand, they thought, to 22.5 going out. Notice how if you had the triple play was when we had a PE that was depressed, and it was going to go on up to, we had 12.2, and they were estimating out 22.5. There's PE expansion. You had a depressed price, so there you go there. And last but not least, you wanted to have your net profit margin and operating margin consistent. This company has that, even with COVID going out. And look at the net profits margin. It's doubling from 2019 to 2000, all the way out to 23, 25. So you've got great management here, and management with capital allocation. So, and if you notice the return on total capital, this company is consistently 5.4 going out. They thought it'd be up to 9 because they were expecting not COVID, and now it reduced to 7. But overall, the capital allocation that the management has on this company is outstanding. These are the kind of people who I want to have my money with, because they're great capital allocators. And last but not least, the value line, oops, one more, back up. Value line, it says the shares have fallen more than 40% since the last report in January due to COVID. Still, the yield is attractive at this level. To a 3 to 5 year appreciation potential is above average. So even if we are at 47, 48 going out and we get to 60, that's another 20. And I don't think that's our minimum, but the high could be $90 a share. Next slide. I always like to see if we have any insiders buying anything, and look at The president of the company bought 10,000 shares and he paid $39.39. That is an outright buy of the shares. All these other 9, as the green circle says, purchases, those were always awards or options. This $39.39 is what I like to see, is when the insiders are buying the stock on their own with their own money and going out there and buying it because they think it's undervalued. So I hope you guys will consider Wyndham Hotels for your portfolio. Thank you.
Thank you, Kim.
So Ken, was I under 7 minutes?
No, you were at 10. Let's go on to Taylor Morrison. I sat down a couple days ago, started looking for a stock, and decided I wanted to buy a home builder. Maybe this will be a quote that will live in infamy in the next 5 or 6 years, but I think home builders have been unduly hit by a lot of things, including COVID shutdowns in many states. So let's take a look at Taylor Morrison. It might be a new name to a lot of you. They operate under a number of different brands in the gray box, and this is definitely a non-core stock when I add it to this portfolio, or if I were to add it to my club's portfolio. Next slide, please. Here's where they operate. They operate in the high growth areas, exactly where you would expect a very successful home builder to operate. On the East Coast, that's Atlanta, that's Charlotte, that's other parts of North Carolina, Raleigh-Durham. You can see the Florida markets, the Texas markets, that's Denver, Colorado, and then we have a couple up the West Coast. They just completed a huge merger with another home builder that gives them a lot more access to the Oregon-Washington market. Next slide. If you're going to build homes, you need somewhere to build these homes. And Taylor Morrison has been very aware of buying land in these high growth areas. If you take some time to figure out that chart on top, it's showing you where they own lots and where they control lots. They don't necessarily own the land, but they control the building on that piece of land. Gives you total lots, and it's showing you over on the far right the supply in total years that you might expect for these owned lots. So Taylor Morrison has enough places to put homes for the next 4 or 5 years. They control a lot of land. You can see the kind of homes they build. About a quarter of their homes are in the entry level markets, with a little bit less than a half in that first move up market, and then of course smaller percentages in other categories. Very little building in the urban infill market. That would be things like condos and townhouses into the outskirts of a large city. Next slide. Taylor Morrison has consistently been rated the top home builder as far as the most trusted home builder in the country by the National Home Builder Association. And you can see in the most recent year, 2020, that sitting third on the list was William Lyon Homes. Well, that's the company that Taylor Morrison just completed a huge merger with. That merger closed on February 6th. So we're going to have 2 of the top 3 most admired home builders, most trusted home builders, sitting together in one company. Taylor Morrison also has a large unit called Able Ready Own, which does a lot of work with financing. In other words, it takes people that want to buy homes with Taylor Morrison and runs them through a lot of education, pre-qualifies them for mortgages, gets them ready to put their money down, and makes them aware of the responsibilities that they're going to be faced with as they move through the closing process. It's a significant piece of their business that they run. Next slide. You know that I love to go to Chronicles when I'm working on stocks, and I wish I would have bought Taylor Morrison a month and a half ago. I wish I would have decided I wanted to own a home builder a month and a half ago, because they were just practically being given away at that point. But even today, the par value, and if Mark will circle the very end of the par graph, you'll notice that even today, the par value is historically high for this particular company. When you run your eye horizontally across the graph, it's still pretty decent. Taylor Morrison does not have one of these 80, 90, 100 quality ratings. None of the home builders have those types of quality ratings, but we have been in a generally upward swing in quality for the last year plus. You can see the blue line as it took a steep dive off the high dive board right there, and now has been steadily moving back in a generally positive direction. I think that's telling me the kinds of things that I usually want to look for. And remember, this is a non-core stock, so I'm going to be a little bit on the wild and crazy side when I'm making this purchase. Next slide. Here's the visual analysis. The sales line is certainly consistent. The earnings per share line, a little choppier, mimics pretty nicely a lot of the different home builders. And notice COVID took a big bite out of the stock. If you'll do one click, Mark, I'm drawing your attention to the upper corner of the SSG Plus, and I'm indicating that my projection is going to be done from the last piece of annual data. In other words, this fall off the cliff quarter, which I expect to continue for at least one more quarter, I'm going to ignore when I'm setting my projection at the moment. One more click, Mark. There's that fall off the cliff, and I'm going to fall off the cliff, and I'm going to expect that fall to continue for another quarter or so, and it's not going to upset me when it actually happens. For a non-core stock, I'm setting up my thesis. I know exactly what I'm looking for, and as long as I see it happening, I'm not going to be upset with price movement. One more click, Mark. Here I'm pointing to the second year out, the 2021 fiscal year line, and the end of that arrowhead is about where I'd like to see the last quarterly figure or the annualized data. I'd like to see it right around there. In other words, in 2 years, 7 more quarters, I'd like to see it come very close to matching where it was pre-COVID. After that, I'd like to see it move to that trend line that I'd set, and I'll show you how I came up with that trend line if you do one more click, Mark. There it is. That's the one I want. It's up on top there. And I used earnings growth of 3% for this year, 7% for the year after that, and then 12% for the next 5 years. Now that 12% is considerably under where Value Line and Morningstar and CFRA and the company feel that their growth is going to come back to. So I think that I'm being conservative even when I'm put the pedal to the metal in the last 3 years, but I'm starting out with this idea that I'm going to have very anemic growth. If that kind of growth happens, then earnings will grow from about 235 to about 364, and that's where that diamond at the end of the dotted blue line is, and it's showing me what's going to be happening. It's smoothed it out, kind of. Next slide now, Mark. Using an overall growth rate of 10%, that's smoothing out those 5 numbers I gave you. And I'm using that 10% for earnings and the for sales and for earnings, and then picking a high PE of 13 and a low of 6. I'm getting a really nice par value, a really nice total return value, 3.7 to 1. That 10 isn't as high as sales growth number for EPAM, but I think I'm on the extremely conservative side, and I would look for that number to move up as we hold this in the portfolio for the next couple, 3 years.
Okay. Thanks, Ken. We'll go airborne with Mr. McManus and United Airlines one more time.
Hey, Mark. Yeah, I'm going out with yet again with United Airlines. Just to recap what I normally do, I check out what I bought already, and to the extent that I can, I like to add more of it if the price and the quality of the company are cooperating. And when I bought United Airlines in this hypothetical portfolio a few months ago, I hadn't owned it before, so it was new, but I bought it, I think, every month since. And when we look at the price jumping around the place, you see I tend to buy it at the high each month. It tends to sink down the week after we have this roundtable. But as I said, all else been equal, I like to buy what I bought before. If the reason is compelling and the price has gone down, then the reason becomes more compelling, unless for some reason the earnings engine has been disrupted. So if we move on to the next slide, it's just a repeat of what I showed last month. It's a synopsis really of United Airlines. It's a major carrier in the US, number 4 in terms of passengers, but it has one of the largest international networks. That has been disrupted disproportionately in this pandemic. So let's hope that it will recover and bring the stuff back close to where it once was. Might take a time. As I'll show you later, I'm not worried about the kinetics. I'm worried about the state where it ends up. So the speed where it gets back is not as big of a concern. And if we move on, it's just a pie chart that shows the breakdown of the major carriers in the US. You can see United over in orange towards the bottom left, 7 o'clock or thereabouts. He's the 4th largest, 11% of the market. Southwest is the largest with 20%. And we skip on to the next slide. You can see what has happened over the last couple of months with the pandemic, the SARS-CoV-2 virus, visiting the entire planet. And this is from a website called rootsonline.com, and they update this weekly, so it makes for very interesting reading. Nice article coming with it. It shows capacity this year in red versus last year in black. So you can see there has been a precipitous drop, but it is leveling off. It has been dropping, but the last 2 weeks it is leveling off. And on the next slide, you can actually see the percent of each of the airlines in the US. It doesn't show international carriers, but the percent that are grounded. So it's showing the week ending May 13th of 2019 versus the same week number this year, which happens to end in May 11th, a leap year, adding 2 extra days to this year compared to normal years. And you can see there, United has had the biggest drop in capacity, but our fleet that's grounded, but that's got to do with fleet management as well. Southwest tends to like to fly a lot of its planes, even a little bit empty, just to keep them in service, whereas Delta and United have grounded a big chunk of theirs. Delta is sitting not far from here in San Bernardino County, and there's a company there that is maintaining their fleet, starting them up, rolling them around the place, making sure they're ready to go when all this ends. And if we skip on to the next slide, it shows what the stock price has done. It seems to be, in the last 3 months, on a very slight downward trajectory. You see, last month, I managed to buy it at the end of the month close to 30, and it got as low as 20 again this month, and now it's back up to 29. I'm proposing we add it to this portfolio again for this month. And if we move on, this is taken from Manifest Investing, and there'll be a talk about this process where you look at the quality and the projected annual return of a company. The PAR, the projected annual return, is in that purplish line, and it's shooting way up because the stock has been greatly depressed. And this may have been done actually before analysts' projections of where things were going to go have been revised. And the quality of the company in blue is an aggregate, and that's a little bit more difficult to explain, but there are 4 components of quality, debt being one of them, as I said. And it's a measure of how this company stacks up against others. And the quality, quite frankly, of this airline, and many airlines for that matter, is somewhat low. But this shows that, at least by this analysis, that The stock price is depressed, and it is projected to improve over time. So we move on. You can see that things are finally picking up. I've been looking at this chart for a while. The blue line shows activity in the US, which we saw previously, and we see that it's kind of flattened. It's still a little bit lower on the week of May 11th and the week of the 4th of May. But what's very interesting is activity going to and from China, which definitely dropped precipitously in the middle of February, recovered somewhat, was stagnant for a while, but now is on a definite uptick. And moving on, my little kinetics versus thermodynamics idea is just to say that we don't know when this downturn will end. We know it will end, at least if you're an optimist. In fact, if you're a realist, it's happened many times before, and things bounce back. We don't know exactly where it will bounce back to, but it will improve. But I don't know how fast. That's the kinetics take. It will happen, but it will happen. And while the virus may dissipate, it's the social conditioning, how that will change. How long will it take for people to get up, sit in restaurants, mingle with each other? That's an unknown, but I'm an optimist, and I think it will happen faster than most people predict, but not as fast as someone was cheery optimist. I would give it a year or two, certainly 2 years before everyone is out and about and happy, content. But history supports the idea that you should be an optimist in the stock market when things are bad and prepare for the best. Timing is not an issue. And I believe that is the last slide.
Yep.
Oh no, Mark did this one for me, because the fact is that there are some analysts that are suggesting that United, among others, may have to file Chapter 11, which would wipe out the shareholders normally. It may happen. I tend to fly very, very close to the wind or very close to the sun, and sometimes you get punished for doing that. My hope is that it will not happen in this case, that they will avoid bankruptcy, because that's expensive long term in terms of borrowing and the price that you pay for borrowing in terms of interest rates, etc. And also there will be competition from startup airlines as capacity comes online.
Yeah, I do.
So
I
I think
that's the last one, Hugh. I do think it's kind of interesting to follow the debt capital and how that's gone up $4 billion and huge losses for this year projected. And, you know, that old saying that we've got that stock price follows earnings. Well, this one certainly did.
Yeah.
At least this year. All right, I'll go ahead and try to wrap us up here in just a few minutes. It's 9:35, so we're doing pretty well on time. All right, just a quick screen. I went out and I was looking for double-digit growth and companies that ranked in the top 10% of all companies using that combination of return forecast and quality known as the manifest ranking. So I want companies that are in the top 10% of all companies that we track with double-digit growth forecasts, and then refining it to look for the companies that have the highest return on owner's capital that we've been talking about for quite some time. And you see some interesting companies, including Ken Kavula's Taylor Morrison is third on this list. And there's some other companies on here that are a little bit sketchier, but some decent studies. Ken brought AbbVie to the ABBV to the COVID conference last week. I'm not going to get fancy. I'm going to go with Jazz Pharmaceuticals at the top of the list. Pretty good relative strength index, at least as good as could be expected with the market as hot as it has been, trading down within striking distance of its 52-week low. Decent return forecast from Value Line. Both Morningstar and the analyst consensus think that it's potentially a bargain or on sale, and it's got some upside over the next year or so. Don't know much about the company, so I figured it's time to learn. We've had questions about Jazz Pharmaceutical in like 3 or 4 out of the last 6 or 7 months here at the roundtable. So let's take a quick look at the company. The ticker symbol is Jazz, J-A-Z-Z. It's a company that really kind of came into its own about 10 years ago. They have real products. They have earnings. They have been chugging along pretty well from 2014 up to present day at about a 10% growth rate. They actually have real products that they're selling and accomplishing that growth rate. Notice that the earnings have actually been fairly steady also. Stock price definitely following earnings. Looking for a little bit of probably virus-related downturn this year. They also stubbed their toe on an FDA third stage thing that he'll be talking about a week from today, the FDA pipeline. But what I see is a company consistently growing with fairly consistent earnings, really, really nice profitability. We're talking about 40% plus or minus at the net margin line, and a PE ratio somewhere in the 10-ish range. So again, we're looking at a company that is $2 billion in sales, growing at 10% with profit margins in the low 40s. PE ratio of about 11, which again is pretty cool when you're looking at companies, and a current projected annual return of about 18%. Measuring it against some of the other metrics and how it ended up on this list, really nice debt characteristics, very low interest rate, really nice return on capital that we've been talking about. Again, fairly attractive from a technical standpoint. And then kind of a worst case scenario, according to Value Line, we're looking at a 19% return. So I really like what I'm seeing from the company. Just a quick overview of the stuff that they do. They're into sleep disorders and neurology type stuff, and really branching out into the hematology and the cancer oncology areas. Really solid efforts in many of those areas with good products in place. Most of their development, their R&D is focused on cancer and some of the hematology type stuff. And they have a fair amount of trials actually in progress. We'll take a look at that. Really good discipline when it comes to capital allocation, something that we like to see. You saw that in that 20% return on owner's capital type situation. And they are going after some growth. Now, they did stumble a few years ago. There may have been a change in management. I didn't get that deep into the company. I did see that they curtailed research a few years ago. You may know more about that. But they have actually gone back to, they've gone from a 6% commitment to R&D to a 13% of total sales committed to research and development, which is a very strong commitment to growth. Again, as I said, there's a little bit of a tease. Hugh's going to be talking about how to look at a pipeline. Maybe you'll look at this one as one of the companies. These guys have a whole lot going on in the hematology and oncology, various solutions at different stages of the pipeline process, and some of them are almost to the point where they could have as many as 3 new products actually come out this year, according to the company literature. So some really good potential, really good work in some areas where it's got a lot of potential payoff. So I'm going to go ahead and add Jazz to the portfolio and turn it over to Ken for a poll.
Give me just a second here, Mark, and we'll launch the poll. There it is. So folks, you can use your mouse, you can use your finger if you have a touch screen. Just give us a vote and we will put $1,000 into the portfolio for the audience choices as well. Audience is eligible for prizes at the anniversary, which is coming up in the July roundtable. We do give awards, and sometimes the audience has actually won the award. We reserve the right to give you raspberries also if the audience chooses really badly. So let's see how this goes here.
Oh, do we get to define badly?
You can, well, Mark, you usually do, so. We only have about 2/3 of you voting right now, so just vote. It doesn't cost you anything, and it just helps get a real good sense of where the audience is tonight.
Yeah, it looks like we've got some complaints about people not being able to vote again. I think we had that last month, wasn't it?
Well, if you're having trouble voting, folks, what what I was told was that if you close your control panel and open it back again, you should be able to do some voting. So you might give that a try. Close your control panel down and then open it back up again and see if that allows you to vote. The problem is not with us. It's a known issue with GoToMeeting, and I'm sorry that we're having that issue again. You don't have to tell us anymore now. You're just clogging up the question box right now. So thank you for letting us know. I mean, I'm going to close the results. We did have about 3/4 of you voting. Okay, and let's share the results. And Cy, you're a winner tonight. We're going to go with EPAM Systems, and we're going to add yet another set of stocks that are $1,000 for the audience in addition to your $1,000 into EPAM Systems. So let me hide that. And Mark, if you want to go on to our coming attraction slide, there we go. I'd like to let people know that on June 22nd, 23rd, 24th, and 25th, the BIVA board is going to be running a virtual BINC. There'll be 4 classes run during those 4 days, and the presenters will be Doug Gerlach, Susie Artsberger, Kim Butcher, and myself. And we'll be running classes. You can get a lot more information on the Better Investing website. But again, that'll be June 22nd, 23rd, 24th, and 25th. I'd like to thank you all for coming, and we will stay on for questions, maybe for about 10 or 15 minutes. There are many, many questions, however, and I can tell right now we're not going to be able to get to all of them, but we will try to answer a nice representative sampling of the questions. Mark, do you